Presented at this conference, really outlining what we believed was going to be a transformational year for Horizon over 2023. And, well, I think the results speak for themselves. A year on, the company's smashed a number of records. We saw a 46% increase in revenue to over $152 million US dollars. That's US dollars. We saw production increase 44% to over 1.9 million barrels. And probably the one I'm most proud of, our profitability. We saw EBITDAX shoot through $103 million US dollars. Safe to say that led to significant free cash flow generation, and that resulted in some substantial returns to shareholders. We returned over or declared dividends through the year of over 56 million Australian dollars, representing about a 25% dividend yield for the year. Probably most importantly, it's the sustainability of that dividend. So this wasn't a one-off. In fact, we distributed over the last 3 years over 150 million Australian dollars, represents about 60% of the company's market cap, and represented about a 20% dividend yield for 3 consecutive years on the trot. Probably most important out of all of that is that notwithstanding us returning all of that capital to shareholders, we've been continuing to invest in production growth within our asset base, and really that's the story I'm going to take you through today. What are we doing to sustain production and cash flow generation so that we can keep delivering on these returns to shareholders? We've got the mandatory disclaimer and compliance statement, which I'd encourage you to read. So on to who we are. Well, look, we're an Australian-based company with 2 production assets. We've got a 26.95% working interest in Block 22/12 offshore China. It's the flagship asset of the group. And we've got a 26% non-operated interest in the Maori field offshore New Zealand. Combined, these 2 fields produce about 4,500 barrels net to Horizon. And we've got a strong balance sheet. Net cash was just over $35 million at the end of the financial year. And as I mentioned, we've got a strong history of returns to shareholders. In terms of our strategy, well, we keep it pretty simple. We focus on maximising free cash flow generation from our existing assets. We look at returns to shareholders with a core focus being further distributions. And we continue to invest in production growth, mainly focused in and around our existing assets, but also looking for opportunistic growth opportunities outside of the portfolio, which could really complement the asset base, with a view for them to help support future distributions as we go forward. And most importantly, we feel we're delivering on that strategy. As I mentioned, we had EBITDAX generated from these assets over the year of $103.5 million US dollars. And that's really aided by the very, very low cash operating costs. Our fields produce at a cost base less than $20 US dollars a barrel, which when we're selling oil today at over 85 or over $90 a barrel, it's a significant margin to generate cash flow. As I mentioned, strong cash flows allowed us to sustain a distribution stream, and that's really been the core. We announced an interim dividend halfway through the year of 1.5 cents, and then recently announced a further 2 cent final dividend just back in August. All up, that entails 3.5 cents per share of that 25% dividend yield. Our capacity to generate these substantial returns is heavily due to the low-cost production assets that we have, but also our investment in them over time. So very, very proud. This year, over the last 12 months, we invested about $30 million US dollars, particularly in our China field, at bringing on a satellite field development, the 12-8 East field. And that really boosted production rates. We saw production rates double from that field alone. And that's really what's enabled us to sustain this really strong cash flow stream. Importantly, we've got a pipeline of future opportunities, further infill drilling, which we continue to invest in order to keep that cash flow generation going. And as I mentioned, we also do look for other opportunities outside of the portfolio where they can enhance our returns going forward. Just looking at a bit of a snapshot at the share register and the share price. We've got our market cap's about 260, I think it's $270 million today, and we've got a very supportive shareholder base. In terms of the chart here of the share price, you've got the Horizon share price in the orange, oil price in the green, and the ASX Energy Index in the blue. You can clearly see the correlation in the share price to the oil price, which is not a surprise, through the early part of this chart through the middle of 2022. But what's particularly pleasing is this dislocation we've had from that point, which was really driven by the substantial success we had at our fields in China, where we had a reserves upgrade given the production success, and that's really allowed us to supercharge returns to shareholders, given we're punching above the just movements in the oil price. In terms of FY23, a couple of other highlights I'd just alert you to. We had a 55% 2P reserves replacement. Our average daily production rate increased that 44% I mentioned to over 5,000 barrels of oil per day. On ESG, despite elevated activity levels throughout the last 12 months, we maintained a very strong safety record, significantly below industry benchmarks, or better than industry benchmarks, I should say. And on climate change, we set a net zero ambition some years ago, and we made a seed capital investment in a carbon removal credit developer during the year to help aid with those decarbonisation efforts and potentially provide a future long-term additional cash flow stream. So turning to the assets and starting with Block 22/12 in China, as I mentioned, this year was really underpinned by a substantial new development being the 12-8 East development here at the bottom of the slide. We've made a $30 million investment there, and combined with some infill wells drilled up in the 612 field, that really supercharged production from this field, doubling production rates to over 20,000 barrels of oil per day on a gross basis throughout the year. The additional production took the cash flow generation of this asset alone to over 80% of Horizon's cash flow. And again, it's very much aided by the very, very low cash operating costs, which were less than $12 a barrel. I'll come to this in a moment, but these fields do naturally decline and we need to keep investing. And we've got a considerable pipeline of future opportunities, which are outlined on the next slide, of how we continue to unlock the value from the asset and keep this cash flow going. So this slide really just points out all the various future opportunities comprising of infill wells, water handling upgrades, and other workover opportunities, all fairly modest individual costs. We drill a well here for about $10 million on a gross basis, and we get payback periods of 6 to 12 months. So it's a very, very lucrative asset to be a participant. Probably my favourite slide is this one, where we put here both the history of the production and our view of the future in the asset. So we've got in the light green the production history, the dark green our 2P reserves forecast going forward, and probably the most important part, the light blue, being what we see as indicative future activities, being those infill drilling opportunities that we continue to progress. And what is most obvious from this slide is that historically, we sanctioned this field on this orange profile, and we've been able to, for a decade, continue to invest in infill drilling and other activities to sustain production rates at around 8 to 10,000 barrels a day for over 10 years. And whilst the future forecast, 2P forecast shows this decline, our intention is to continue to invest in these infill well opportunities to sustain production rates well above the average. And this is the continued value we continue to unlock and what is driving the cash flow returns in the company. Moving on to Maori. Maori also continues to be an important asset for the company, generates around 20% of our cash flow. What you see here is we had successful workover operations during the year, which was combined with continued water injection into the field, which allowed us to sustain production rates towards the end of the year at over 5,000 barrels of oil per day. It's got a very different decline profile to Block 2212, so we don't need to do that reinvestment in infill drilling, which I'll touch on the next slide. Here, the operating costs are still modest in the context of the current oil price, and we achieve very strong premiums to dated Brent. Most of the focus of the venture is on low-cost workover activities focused on sustaining production rates, and we're looking at an extension to the permit, which I'll touch on more on the next slide. So here's I guess the Maori forecast. Again, bit of historical production, our view of the 2P reserve forecast, and as you can see, it's got a very, very modest decline profile, really underpinned by that strong water injection into the field that sustains production rates without the need for significant capital expenditure. Whilst there is some blue sky, so to speak, in some future activities, these would require a fairly substantial amount of capital expenditure and a significant extension to the permit to be viable. So we don't put a lot of focus on that. Instead, our focus is really on extending the field out 3 to 5 years, just by maintaining production rates, maintaining that water injection into the field, and that alone has substantial value, would add substantial value to the asset. So look, in conclusion and in summary, Horizon's had another strong year, or very strong year, delivering significant value to shareholders, and the outlook continues to remain very positive. We commenced FY24 very, very well, with production rates continuing to be strong, and we've seen that strengthening in the oil price, which really bodes exceptionally well for future free cash flow generation. Our focus is on bringing on to production this pipeline of infill wells, particularly in China, and the low-cost workover activity in Maori to sustain production rates and continue to drive that free cash flow generation out into the future. We're determined to deliver value to shareholders, and we continue to focus on delivering those significant returns through future dividends. And in terms of new business, we continue to focus on investment in the assets we have, but also keeping an eye out for those future opportunities. So I'll leave you with that, and I look forward to coming back next year and highlighting the continued value we've been able to generate for shareholders. Thank you.